So here's how you should reduce your taxes if you're a high W-2 income earner. The obvious is to max out your 401k. I wouldn't be a tax strategist if I didn't tell you to do that. But the second thing you should be focused on every single year is acquiring one short-term rental property. If you can acquire one short-term rental property and rent the property on average 7 days or less per customer, you can activate losses on the tax return. So now we should end up performing what's called a cost segregation study. This is the strategy you're gonna use once you acquire the short-term rental. And this is gonna give you anywhere between 20 to 30% of your purchase price as a year one tax write-off. So let me give you an example. If I buy an investment property, one short-term rental at $500,000, I'm getting 20%, so that's $100,000 in year one depreciation. If I'm earning $100,000 as a W-2 taxpayer and I have a $100,000 loss, I'm paying zero taxes. And this is why W-2 taxpayers should focus on short-term rentals in combination with their retirement.
Now, the spirit of what's being shared here is something I can absolutely get behind, but the reality is you need much more precision. Now, the exception to the passive activity loss rule for short-term rental requires much more than simply 7 days or less average stay for your tenant. The biggest issue tends to be in the area where you have to be the one majority working in this business, meaning no one else can actually contribute more effort and energy to this particular enterprise. So that really rules out professional property management, and it could also throw a wrench in the works with regard to your cleaning staff.